And now let's talk about the construction and use of cash budget. So budget is a financial plan to coordinate business activities. The cash budget is it is a planned cash receipts and cash payments. So what are the steps? We start with beginning the cash balances. We add the budgeted receipts and then subtract the budgeted payments equals the cash available before the new financing and compare cash available to budgeted cash balances. So if you don't understand this one, then don't worry about that. We will understand it through a numerical example. So here we go. We have the budgeted period can be a year, can be a week, can be a month, can be a year. So this exhibit, which is exhibit 4.14, it shows cash budget for Mid-Atlantic manufacturing for the year 31st December 2014. So this is a year-ended one, right? So you can see the first section is cash receipts. These are all the cash receipts, and then cash payments at the end, the budgeted cash balance needed, any additional finances and new finances needed, we added it there. So how we construct that, let's talk about in our coming slides. So I have kept a illustration here where I just want you to pause the video and read all the questions by yourself, and then we're gonna read it together and solve together. Okay, we have Kachina Corporation is preparing a cash budget for 2015. Kachina ended 2014 with a cash of 68 million. It means the opening balance for 2015 is 68 million. And managers must keep the balance at least 70 million for its operation. So at the end of the year or the start of the year, the manager must maintain $70 million cash to keep to meet the operations. The collections from the customers are expected to 11,925 million, and payments for the 2015 are 6,210 million. So Kachina also expects to receive interest payments. This is receive interest payments, okay, 15 million. Operating expenses payments are budgeted 2,653 million, that are our payment section. During 2015, Kachina expects to invest 1,922 million in a new equipment. That is the investment that he want to make in 2015. Debt payments scheduled for 2015 with a total of 683 million. That is also a payment section. The company forecasts net income for 893 million for 2015 and plans to pay dividend 448. That is just an information, but actual cash payment is for dividend is 448 million, right? So you are required to prepare cash budget for 2015. And will the budgeted level of cash receipt leave Kachina with a desired ending balance of 70 million, or will the company need additional financing? Let's talk about that. Okay, so we have made here the cash balance. Cash balance starts from the beginning cash balance, which is 68 million. Add budgeted cash receipts. The budgeted cash receipts are from customers and from interest. We have 11,925 and we have 15,000. So our total cash collection here, it is 12,008. So we have total cash which is collected from here is 12,008. And then we have cash payments. So we have purchase of inventory, we have operating expenses, we have investment in equipment, we have debt payments, and we have dividend to pay. So total 11,960. So you less the amount here from receipts to payments, answer would be 92. And what you have to maintain, how much? 70. So it means you have additional 22 million to invest into a bank or whatever you want to plan for investment. You have extra 22 million. Our last learning objective is that report the cash on the balance sheet. So let's explore that. So the balance sheet starts from cash and cash equivalents. So normally what we call that cash equivalents. Cash equivalents are time deposits, certificate of deposit, high grade investment, government securities, which is 3 months or less. So most companies have numerous bank accounts, but they usually combine all cash amount into a single total called cash and cash equivalents. So cash equivalents are also liquid as cash. It means you present it to a bank or to someone else and he will give you cash instantly, close to cash. But the most liquid asset is always cash, and cash equivalents are liquid but less liquid than the cash. Okay, so what are the time deposits? Time deposits are interest bearing accounts that can be withdrawn for immediate use. You save it with the bank, $22 million, earning 1% interest, and you say that if I need it, I will take back this $1 million at any time. Okay, sometimes there is a clause of compensating balance. So what does it mean? The cash account on the balance sheet reports the liquid assets available for day-to-day use, right? If you return, if you have seen, cash written on the balance sheet, so that amount is means that is the liquid cash that can be used. So none of the cash balance is restricted in any way. So any restriction amount on the cash should not be reported as cash on the balance sheet, right? So for example, cash pledged as collateral is reported separately because cash is not available for day-to-day use. For example, your cash account is 92. For example, in our previous uh, cash budget, the ending balance of the cash was 92 million, right? And for example, if the company bought a piece of land and there was an agreement that in no way you have to maintain 70 million in your cash account for them if you cannot pay the payment. So the 70 million they can ask from the bank to give on your behalf. So it means from this 90 to 70 million you cannot use this. It means that is not liquid, that cannot be reused. Okay, it means that is restricted. So we write it down on our balance sheet as 22 million because cash on the balance sheet means that this balance is ready to use or day to day you can use that, and we will report this 70 million into the notes of balance sheet. So let me just remove it and discuss further. So the example of this compensating balance is that, for example, cash is pledged as a collateral and we will report it separately. If the company fails to pay the loan, the lender can take the pledged cash for this reason. So the pledged cash is illiquid or less liquid. So also banks often lend money under compensating agreement. What does it mean? It means you ask bank for $100 million loan. Bank give you the cash. You receive cash of $100 million. But bank says that in no way, in no time, in a year, your balance should go from below from $20 million. It means from this $100 million, $20 is restricted. You cannot use that one, right? So the borrower agrees to maintain a minimum balance in checking account all the time. So the minimum balance becomes a long-term asset and is therefore not a cash in these normal senses, right? So in compensating balance, it will be written down in our notes to the balance sheet saying that $20 million is compensating balance and 80 million we can reuse, right? This is what we mean by compensating balance agreement with the bank. So we have successfully answered our all learning objective, and we have finished our chapter internal control and cash. So I will be uploading assignment 4 on our WeChat group and our Blackboard forum as well. So kindly respect the due date. We also will be having our Zoom meeting. So in our next lecture, hopefully we can have our midterm. So you are required to attend this Zoom meeting because it's very important. We will talk about paper pattern in our Zoom meeting. And also, if you have any query or question, we will also discuss in our Zoom meeting as well. Okay. Okay, here is the end of the lecture. For the next time, hopefully, we will start another exciting chapter. And until then, take care. Have a good day. Take care. Stay safe and stay at home. Bye bye.